Good afternoon, everyone, and welcome to Colliers International India's webinar series. I'm Sukanya Dasgupta, the head of marketing for Colliers International in India. And today, our transactions and capital markets experts will be sharing key insights and recommendations on revival strategies post the COVID-19 lockdown and how to optimize business profitability in the new normal. Our speakers are Arpit Mehrotra, Managing Director, Office Services South India, and Piyush Gupta, Managing Director, Capital Markets India at Colliers International. The session will be moderated by Megha Maan, Senior Associate Director, Research. For ease of process, we request you to please type in your questions in the questions tab, and we'll be very happy to do a Q&A round post the discussion. Without further ado, I hand it over to you, Megha. Thank you.
Thank you, Sukanya. Thank you. I welcome you all to this session once again. I would like to begin this discussion in the view of Unlock 1.0 that we're currently in and how occupiers and investors are responding to these changed market dynamics. So let's hear it from Arpit first about how has the market fundamentals changed post-lockdown, and has some markets shifted from being developer-centric to occupier-centric, especially in cities or micro markets which have low vacancy.
Arpit? Thank you so much, and thank you all joining in. Firstly, good afternoon from Colliers, and coming back on the question from Megha. So market fundamentals in markets with a low vacancy have not changed much in terms of rentals, and it continues to be developer centric. However, we have started witnessing some flexibility from developers in terms of some clauses pertaining to CAM, security deposit, rent-free period. Even with the partial suspension of lockdown, there are restrictions on the frequency on domestic travels and restrictions for international travel equally, which will continue to slow down the decision-making process in this sector. But a lot of occupiers today are reviving their lease contracts and looking to negotiate rent, CAM, and other charges. Our developers are politely refusing their request, and so no such reliefs are passed in the markets with tighter vacancies. So in short run, delayed decision-making, contract renegotiation, measurements, and effectiveness of work from the home seems to be underlying trends. Market fundamentals still looks positive and won't change much in a long run. Megha.
Right, but with all these sentiments around Arpit, how do you see the pan-India demand for the rest of the year? I mean, I understand last year we saw a peak in office demand of about 58.6 million square feet. But now are occupiers bullish? How do you see the demand going for the rest of the year?
You're absolutely right, Megha. In fact, everyone knows 2019 was a great year, and we have touched absorption around 59 to 60 million square feet, primarily driven by IT, ITS, BFSI, consulting, and a lot of growth has happened towards co-working spaces. In markets such as Bangalore, Chennai, Pune, total vacancy was single digit, highlighting the strength of the Indian office market. Despite slowdown visible in an Indian economy, the corporate world was betting big on India long-term potential. We have seen good amount of institutional money poured into the office real estate with top PE players in the past few years. As economic activities got disrupted following a nationwide lockdown, some amount of disruption is starting to emerge in the otherwise buoyant real estate. Due to uncertainty and paranoia, larger organizations are deferring key leasing decisions. However, we have not seen occupiers backing out from the long-term pre-commitments, as there is still 2-3 years away from the delivery of the projects. Demand has certainly taken a hit in the short run due to ongoing pandemic crisis, and it will continue to be difficult to quantify the impact of this point, as we still don't know how long this crisis will continue. COVID-19 cases are increasing across India, and we don't know when the curve will be flattened. Occupiers will only start operating at higher capacities from office once the starts declining. The co-working operators have been severely impacted, as they have been growing with a rapid pace and worked on the principles of collaboration spaces. But additionally, the operators who had delivered the spaces from an enterprise perspective, which is as per the client requirement, they are still very positive about this. Given the growth potential of our economy, occupiers will continue to be bullish on long term. Real estate portfolio will be growth. We don't foresee any major impact on the long-term commitments, Megha. We have seen hiring take place in some sectors. Even while there was a lockdown, there was already a hiring which was happening, and the people were doing now online hiring because they were not there in the office. So once the pandemic settles, office market will be the first one to recover. Megha.
So we're bullish about the office markets to recover in 2021, right? I'm glad that you mentioned about the investments specifically in the office markets. So Piyush, similarly last year there was a peak for private equity investments in real estate. We saw about $6.4 billion coming in. How does the estimate for this year look like? And are there any decision-making challenges that investors are foreseeing?
Thanks, Megha. Thanks, Arpit. As Arpit mentioned, the long-term commitments, we don't think it's going very haywire. But what we got 6.5 billion last year, to be very frank, I'm sure this will definitely go down to even more than half, right? And if you see, the first 2 quarters have been completely washed out from the investors' perspective. The investors and investment will happen through sentiments, and as the way our current market is, every day we have a new data point on the COVID side, then government policies. We have different growth rate expectations. Sometimes people say we are contracting, we are at 1%. So all these kinds of negative news coming in on a daily basis, it definitely make investor more jittery. Second is our global investors, who've been consistently investing in India in last 5-6 years time. Consistently across different asset classes, we have seen that investors will want to now see what's happening on their existing investments instead of committing anything new in the immediate future. Whether investors who invested in commercial have also invested in retail, also in hospitality. These are the 2 sectors which have got impacted very badly, in a relative sense. So they're more in the asset management mode, and this is nothing peculiar to India. Even if you look at any other global market, most of the investors have now become more inward looking to see what they want to do with the existing investment before they start looking at the new commitments. We also see underwriting challenges. If today, as Arpit was mentioning, that people may renegotiate to some extent on rentals, on deposits, on rent-free period. So all these kinds are evolving. Whether we go southwards or we remain where we were before COVID, is possibly in maybe next 1 or 2 quarters you will have more clarity. Even if you talk about from the residential perspective, any investor will want to know what kind of velocity you can expect on a quarter-on-quarter basis. When you can see launches. We haven't seen any kind of launches in last, hardly any launches, I would say, in the last 2 quarters. So I think all these things, possibly, make decision a bit challenging. But we have already passed 3 months, and maybe next maybe 3 or 4 months time, we will things start settling down. Megha.
Right. I hope so, because if we look at the supply side of dynamics, being on the research side, we are looking at revision in numbers month on month, right? So if I look at the grade supply, which was expected, that we had anticipated in the beginning of the year for 2020, was around 60 million square feet plus across 7 cities. However, we're sitting here half of this year, and we see about 30% of that supply getting delayed because of labor shortages, etc. So, how will that impact the occupier market, and will it impact the rents also? And what can occupiers expect, Arpit?
So, Megha, absolutely, it will certainly impact, and because of the labor shortage, deliveries will certainly get delayed. In our estimate, at least it will get delayed by at least 2 quarters to 3 quarters, and maybe the rebound is much faster based on the labors coming back much faster. But at this point of a time, it is a challenge. We see limited depreciation this year as compared to the previous year due to the sudden drop in demand. Developers are offering more flexibility in terms of like I talked about rent-free lock-ins and keeping the headline, but they want to keep the headline rental the same. That's important because from a cap rate perspective or from a Piyush perspective, from a capital markets perspective, the headline number has to remain the same. So developers will be cautious to launch speculative buildings and will focus more on a build to suit transaction, because the deliveries, firstly, you get committed with the client and the deliveries will come in 2-3 years. So occupiers who are planning 3 years later in terms of strategies will make commitment, and they will stop towards a speculative construction because of the labor shortage. If situation improves with respect to the ongoing projects, work has started at many places and the deliveries are getting affected, like I said, by a quarter. But some micro rentals in some micro market like BKC, Mumbai or Outer Ring Road, which is in Bangalore, might get corrected if we sail through this crisis, as occupiers are looking to alternative upcoming micro market that offers new infrastructure at competitive rentals. Occupiers might look the relocations and renegotiations during the existing lease renewals, which will also impact the rental appreciation. So it's a challenging time for everyone. So this industry cannot say that this is not the challenging time. It is a challenging time to everyone. So we foresee that short term it will be hit, but from a long term, sentiments are positive itself.
Right. It's a good point that we will see the speculative supply going down. And as you mentioned, there may be slight, rental changes or rental decline in certain select micro markets. Now, if there are rental declines, how does it actually change the investor view for income generating office assets, Piyush? Any other alternate asset classes that investors can look at?
Yeah. So, first, if we just continue our discussion on the, commercial, see, most of the large occupiers in India, which are maybe technology players or international banks, IT enabled, they haven't shown any significant change in the requirements. The long-term story that India remains to be most cost competitive with quality infrastructure from an office perspective. Rentals below a good quality office below $1 to $1.5 per month. That remains the key thing which continues to drive the investors' demand towards commercial real estate. Even if we talk about some specific performances in say if at all we talk about April month, someone like MAC REIT, who has one of the biggest office owner in India, they collected more than 90 to 92% of the rentals. Their occupancy remains over 93-94%. So considering that, commercial still remains one of the most favorite for all the investors. And if you talk about as late as last 2 days back, Blackstone sold about 300 million worth of their REIT shares, to an investor, which indicate there are global investors even in today's market. They are willing to invest. So, if you look at a cash yield of about 7%, which, I'm talking about MSC REIT's perspective, is still an attractive investment. So a cap rate of about 8.5, 9 is what we generally talk about, and the risk premiums have increased. So what differential over a 10-year bond we used to get maybe 1.5%. Now it's increased to about 3.5%, which is the risk premium because of the pandemic. So which remains a very attractive, market, and not only in India, but even if you compare to any other emerging market in Asia or elsewhere, a 3.5% and an 8.5, 9% absolute return is a very, very attractive market, and investors remain bullish to that extent. Other opportunities, yes. I think residential is one among the important ones which had got ignored, in last 4 to 5 years time. In fact, in last 6 years time, we have seen most of the investments coming in yielding assets, whether it's warehousing, data centers, and commercial, of course. But residential is something which definitely took a hit. I think overall residential, the demand supply remains in favor of demand. We have seen some kind of crisis because of the liquidity in the banking system and the NBFCs, and developers not getting enough liquidity, so projects are stuck, and that has created a lot of negative sentiment in the industry. For investors, opportunity on residential side remains attractive to acquire apartments, large-scale apartments which are completed or nearing completion. So, and in residential, the pricing is absolutely mispriced, I would say. One is able to deploy large capital at low risk and high returns. Yeah. So I think from that perspective, residential something is going to come back, and there are selective investors who are looking at residential from a long-term perspective. One is opportunistic play, which one does by which is a window for maybe 6 months, 9 months, 12 months time to do high yielding credit with low risk. But there is also patient capital which residential will attract. And as late even in last 1 quarter during lockdown, we have seen two large deals happening on residential front in Mumbai. One by a Japanese investor and one by an Indian investor. So residential is among an important ones not to be ignored, apart from warehousing, industrial and commercial.
Yes, I was about to ask you the question because residential private equity investments have actually dropped 20%. If we look at the period from 2016 or 17 to 20 and compare it to the previous last 3 years. So, but as you're saying, there are green shoots. It's a long-term play, and investors should definitely look at residential as an opportunity asset class. So just for our audience, I hope you're dropping your questions in the drop box or the chat box here. We will take these questions after the discussion is over. Now, getting back to what is happening currently, work from home is kind of being accepted. It's become a new norm. Social distancing is at the core. Occupiers, developers, both of them are aligning to this new normal. So Arpit, how are occupiers and developers managing business continuities and operations in these times?
So Megha, just to add from a work from home perspective, work from home was always a concept in India, especially from an ITS perspective. They were always given a space, probably a day in a week or 2 days in a week, where they always had an opportunity to work from home. That is the reason when this lockdown happened and the infrastructure was up and running at home and people were able to take it. But certainly it came up with a lot of challenges because no one expected this to go as far as we are talking about it at this point of a time. The biggest of the challenges, especially India versus US, I talk about where in US every house has an office, right? In India, what we do is that we live in a small houses, right, with extended families with each other. And now during these times when the lockdown was happening, one room probably kids were equally there. Kids, online classes, and so bandwidth was something which came up as a lot of surprise to everyone. But I think we sailed through with this. But you rightly said it came with a lot of challenges because no one had a proper workstation, chairs, and there were younger people who were staying in a PGs, and they were the one who got impacted majorly because the food was an issue, and the postures is also coming up. So again, it is coming up with a challenge, and people are not enjoying as much as we talk about it. So from an occupier perspective, the moment you, even though the restriction have eased out, there is still hesitation among occupiers to resume work from office with higher strength. Till now, we have only seen a skeleton staff coming to office to ensure the critical functions, IT equipment run smoothly. However, as restriction eases out, further we foresee the slowly occupiers will start operating from office with the increased numbers. Many companies, especially in the IT and ITES, which used to give around 70 square feet per person to 80 square feet per person. So I remember 2007, 2008 used to be given 110 square feet to 120 square feet per person, especially in R&D and technology. But over a period of years, densification was something which was coming in. So I foresee that post this lockdown 100% opens up also, there will be some part of an employee will be doing work from home. So what these occupiers will do is that they will give a re-densification of an employee. So where I was given a 70 square feet per person, maybe I will go back and give 100 square feet per person, but the remaining amount of people might go back and work from home. So it's going to be a new normal, and social distancing norm will still impact. And I think that it is in the time where we are living in, it is needed to give more space to people who are working from office.
Right. This just reminds me that we did a report very recently called In Pursuit of Health and Wellness a couple of months ago, and we suggested that occupiers are taking multi-pronged approach to wellness, navigating through these current times. They're implementing density norms, as you rightly said. They're repurposing their floor plans. We also recommended use of Colliers Back to Work Navigator, which is a tool that helps in giving recommendations around design, technology, navigation, hygiene and cleaning, etc. But in these current times, are you really seeing, occupiers reinventing their real estate strategy? How are they sailing through, and how does the commitment on office portfolio look like?
So, Megha, honestly, if you go back and see it, always innovation comes in a difficult times. So these are difficult times. So certainly the innovations will come. Some of it has already come, and some will come over a period of a time. Most of the occupiers today have gone back to the drawing boards, and they're analyzing their real estate portfolio from both short term and long term. Cash is a king, like I was talking about before, equally, because everyone want to understand what cash they have. No one wants to get into burn rate in the challenge, especially a short term. So in short term, occupiers are leveraging the relationship with their landlords to discuss options of relief in rent, CAM, and other charges. It is important to note that the landlord are in the same situation as tenants are in many circumstances, because if I have that asset as a rent yielding income for me, and if I pass through anything back, so that becomes a challenging time. But I have seen most of the, maybe not in the commercial asset, I have seen the relief coming in much, but in a retail assets, and Piyush can add furthermore, I have seen most of the bigger developers and bigger landlords have given reliefs to the retail side. Now, it is difficult to say that this much amount of relief is right or wrong, because there cannot be always be a right and always be a wrong. So, but I have seen some relief in coming down in the retail side. On the long run, occupiers are revising their headcount projections, because they wanted to be very sure now what is the headcount projections. Work from home policies now. Security is one of the major concern from work from home. They are just trying to see how it works out. Space planning. So in the current scenario, what they are thinking about in the long term, carpet area allocation per employee. They are also checking they're analyzing their lease exposure to the market rates. While consolidation seem to be the trend past few years, but we will see that some occupiers may come towards they do not want to invest towards their capex, and they would look forward for either some player who will be investing on a lease operating income for them, or they will go back and get into an enterprise model wherein they have a multi-city approach, or within the city they have hub and spoke model. But that is something which they are talking about. It depends on organization to organization, how do they wanted to plan it. But everything is being planned. They are not leaving any stone unturned, and they are looking and discussing every opportunity which can take care of the future. While no one can predict it, but I think everyone is discussing about it. Megha.
Right. So, you're right. There has been a change in landscape, and it's difficult to predict these times. How about the investors? Looking at now, since 2011, they were looking at steady rent yielding commercial assets, which had limited risk and promising steady income. Now, with the risk return scenario changing, how has the investment climate changed, especially for commercial office assets? Piyush.
So Megha, since the investors are heavily invested towards commercial and as a long-term strategy and the long-term commitment, so that all things to be in place. Now, yes, there is an aberration for maybe 1 quarter or 2 more quarters, which is likely to continue. But we don't foresee any kind of investors moving away to invest in commercial. Although we have to note a point that India anyways has very limited core grade A stabilized properties. So from an investor perspective, options are anyways very limited to invest in. Second is, now investors are also looking to partner with developers or landowners to invest at early stage. What we call as a forward purchase kind of transactions, where investor comes with the owner at a very early stage in the project. What helps is that they kind of control the entire quality and the development cycle. And in the current market situation, it look more apt, because you don't hit the leasing market maybe next at least 2.5 years time. except maybe 5 or 10% just to see whether you can underwrite certain rentals. So investors remain bullish. In fact, we have seen a few transactions also happening in different markets on forward purchase basis, and this is not only in commercial, and we are seeing a similar trend also extending to warehousing, where investors want to do early stage, because once the asset is built out, it becomes expensive, right?
Correct.
And if at all your overall story of India remains intact, and which tend to, and investors do believe it, and that's the reason investors have been investing for a long time. So this is an alternative mechanism to invest in projects at early stage and be part of the entire development cycle, where valuations also today could be cheaper than what you would else get when the asset is fully built out and leased out.
Yes. So, I'm glad you mentioned about industrial logistics segment. This was a big one that had attracted around $2 billion of investment during 2015 to 2019, and mostly by foreign investors, right? But do you see that there are any limited grade A assets or ample availability of such? How's the supply side looks for the segment?
Yeah. So if I said we have limited, grade A commercial, then I don't know. I don't have any word to say more. It's like there aren't. There hardly any, industrial or logistics,
So
assets
this presents
available.
opportunities for developers also there, right?
Exactly. In fact, not only developers, also government. Today government also is trying to, directly tie up with the asset owners so that they can develop, big parks in and around large cities. See, I think the fact remains that the economy and the business will become more organized in future, whether it's for stringent quality control or economies of scale or safety. I think this is likely to happen. Another important aspect is the cap rates, which used to be for industrial logistics around 12, 13. They have almost come in line with what we see in commercial at about 8.5, 9%. Right. Another important point is we talk a lot about a lot of business and industries moving out of China and moving to other emerging economies. So I'm sure there are other competition for India as well. But even if India gets a part of it, I think it's going to be major boost for this. And if you talk about specifically COVID, I think there's a big thrust which has actually come on e-commerce. Right, the entire thing of online shopping has increased multi-folds. So whether the Amazon and the Flipkarts will require a lot of last mile delivery centers, fulfillment centers. You have 3PLs, 4PLs moving very aggressively. So I think this is bound to increase, as we talk. I think another important aspect from warehousing is also on the data centers, right? Data centers, the way I think because of pandemic, all this work out of home, all data of companies is now at home. You need large reservoirs of data in and around large cities for people to manage it. And whether do we have data? We don't have data centers. In fact, we don't have any policy towards data center. In fact, even finance minister made a point in the last budget that government will come out with the overall policy of data centers in terms of privacy, and even maybe data center may even get an infrastructure status. We never know, right? If something of this happens, I'm sure data centers will get a lot of investments. And we have seen a lot of even platforms now being formed which will invest specifically in data centers. So this is, I think, so one asset class among the overall industrial, which is definitely bound to get a big flip.
Yeah, absolutely. The survey that we conducted last year, it also indicated that 63% of the investors are looking at data centers as an alternate asset class. It's driven by government's data localization rules in 2017. Also there were e-commerce policy which was introduced in 2018 that necessitates online players to store data locally. That has actually prompted demand for data centers in India. Now since we are talking about specific asset classes, from an occupier side of view, I think the segment which was under the limelight in the last couple of years was the flexible workspace, or the co-working segment. which actually is around more than 20 million square feet of space and more than 300 players or operators in this domain. So, Arpit, to you, how does the demand outlook from co-working players look like? And are occupiers now looking at more flexible workspaces, which seems like a good deal right now because of low capex and long-term commitment?
I think on co-working sector, I think there will be still a growth, but there will be a lot of consolidation which will happen during these tough times. Megha, like you said, there were around 300 companies. Our last count in India was. Now most of them will not be there at all after the COVID, because the biggest of the issue now, what solution these co-working players were giving us in India, they were taking an asset which was around 100 square feet per person, and they were building it around 40 to 50 square feet per person. So they were making money in hedging difference between the 50 square feet to 100 square feet. Now, the biggest of the challenge which is coming now with the social distancing norm which is coming in, the organization would now again go back to around 80 to 100 square feet per person. So their delta which they were playing on it will get further reduced, and no one will be willing to pay for more, because some of the players who committed what in terms of service deliveries are exposed during this COVID time. So that is another challenge. And from a conventional lease, you have your space, you have a control, you will do sanitization, and everything is in your control. Now these places where you do not have a control and exposures become much higher. But again, this is one part of it. But the second part of the story is that organization will always think now multiple times to invest on the capex. Now these people will come down as an enterprise solutions and invest on the fit outs as per the requirement of the client, and they will build this entire space. So when you build everything which is a build to suit from a client perspective, everything is under your control. Your lock and key is under control and everything. So there will be a lot of consolidation which I foresee in this segment. But now going forward, the client occupier should be very where they are moving in. They should certainly go back and check their balance sheets of the players where they are moving in, because it is important, because you are going with your commitment, whether it is a short term or long term, and you need to know whether the partner is right or wrong. So that's from my perspective, Megha.
So we think that there will be more of flex and core models coming up, wherein some space requirements will be still for traditional spaces and some for flexible, right, Arpit?
So, Megha, from a perspective, honestly, when this co-working came in, it came with as a lot of flexibility to an occupier, right? But if you see last 1 year, last 1.5 years, they are getting into an enterprise model. So co-working is coming down, which is now this industry, while it is called co-working, but most of the transactions we see are more of an enterprise transaction. So co-working principally, which was more towards an SME and the mid-cap companies which were there, now it is coming down, because these are the ones who got impacted the first, right? So the bigger ones who do not want to invest on their capex will go forward along with these players, with the right partners on an enterprise model. So I think this industry will also evolve further. There will be a lot of checks and ticks which needs to be done before they make any further commitment.
Sure. So, I have another interesting one that, if you look at the past around the global financial crisis scenario, wherein a lot of occupiers were subleasing or letting go of spaces because of the economic and business conditions. Do you foresee such kind of trends happening in the near future?
Absolutely, there will be a lot of trends, and I foresee that the business will rebound much faster, because India is a country which is highly English-speaking country with a lot of talent when it comes to technology. The cost of a talent is much lesser. Now, when the stress happens in the European and the US markets, we have seen during the 2008, 2007 times, we see a lot of business opportunities come down towards India, because they have to cut down their cost. And when the business opportunities come down here, so we have seen from there till now, we have seen a lot of GCC companies setting up their base in India, and they're investing, whether it is a back office or front office, they're investing big time. Now post this COVID, when the now China, from a China perspective, now post now the COVID, now things got open up in China. China has rebound. Now around 90 to 95% of the employees are going back to office. Now while they are very cautious about it, but the impact is that once it settles up, it is much faster which will happen. What we are foreseeing is that now, especially the stress which is occupiers are coming in the European and American markets, it will certainly, we foresee a lot of opportunities. We are already under discussion with many GCC players in India and from US itself, and who are willing to step down and come down towards India. So we foresee this will make us learn more. This pandemic will make us learn more, and we will be able to do much better things and much more efficient way coming forward.
Right. I mean, the future looks definitely bright. Office markets are expected to rebound. How about the investor side of business? Piyush, we talked about industrial and warehousing. We talked about residential opportunities and office. Are there any other asset classes that you think that investors should look at?
So I think so Megha, within the entire real estate asset class, whether it cuts across maybe residential, commercial, also maybe hospitality and retail, it's different themes within which one can work. Now, because of so much of stress, there are options for doing high yield credits, right, with low risk. Then there are options to invest in stock last mile funding, both across residential, and commercial. Then we have this forward sale, what we spoke about, not only in commercial, but also in data centers, also on warehousing. In fact, we've been working with a lot of international investors who want to take positions on this, and these are mainly like Japanese investors, both on residential and also on yielding. They are happy, they are looking eager to come early and be patient for about 5-7 years time. So this is, I think this is one opportunity. Then opportunity on residential side to buy out apartments. I think this is something, I think it's a great opportunity where investors could take very limited risk and buy something which is a steep discount to what the current market price of the apartments are. Because of the stress in NBFCs and banking, there is opportunity to buy out bonds of the NBFCs and banks today, which are going at a good discount because of the liquidity pressures within banking and NBFCs. So across the asset classes, within all the asset classes, there are different themes which I think one can work upon, and all these themes, some themes can work for 1.5-2 years time, right? For example, high yield credit is a theme which is going to last for maybe 12 months, 18 months time.
Right.
When liquidity comes in, market will stabilize. You may not have those opportunities. So to buy something on forward purchase at early stage, this option may not remain because today developers want an equity partner on day one because it doesn't get funding from bank to build it. So you want an equity partner. So all these kind of themes are available because I think when they talk about COVID-19 or the liquidity stress in the system. So I think this period should be exploited, I think, by the investors, and I would say more be opportunistic and take pragmatic calls what suits their risk strategy between ranging from doing investment of 1 year to up to 7 years.
Sure. So I just want to take a few audience questions also. Rather than just me asking questions here to both of you. So there's a question which says, what is the outlook on the co-living sector and also the retail sector going forward? So we can have both occupier and investor perspective on this.
So I will take it first. So from a co-living perspective, I think there will be certain improvements and innovations which needs to come in further because the hygiene factor, especially during this pandemic time, so people will be much more careful where they are going in while they are sharing houses or sharing rooms. So they will be much more clear what they would like to do it. At the same time, so they have to. So the segment or the players has to clearly differentiate how they are balancing pre-COVID and post-COVID. So what is the change which they are bringing it now from a retail perspective? It will take a beat for some time. I foresee that people will take a long time to go back, especially to the malls or the cinema halls for some more time. And the OTT, especially Amazon's and Netflix, people are getting used to, and we see the launches which is happening that side. So there will be pros and cons on those side, but I foresee that this both will take little more time than commercial office. Piyush?
Yeah. So I think interesting, Megha. If you look at overall residential space, I think this is the right time for people to actually go and buy apartments, right? You're
Yes.
getting a 25% discount to what prices were maybe at about 6-9 months back. You possibly see one of the lowest home loan rates.
Correct.
Uh,
Absolutely.
what we have seen in last 10-12 years time, it's going below 7 now. uh, the gap between the rental yield on a residential asset and vis-a-vis what your borrowing cost is bridging from a 2.5% yield to a 8% cost has now possibly go down to 7, 6.5, 7, and maybe your rental also may go up. So that also ties into the point on co-living, right? You obviously you have one set of mindset of people who want to buy their apartments, right? But because of the new age mindset and people may not want to buy out apartments at early age, so co-living is likely to work well. And a lot of, in fact, developers we also have been working with have been looking at this model in large cities and more, and along with co-living, also student housing. That is something
Student.
also
Correct.
I think working out well, where certain developers getting investors at their
And it
holding
actually
company.
helps to free up some residential inventory.
Exactly. Because in fact, we've been working with a couple of student housing operators where they want to buy out certain apartments. They tie up with some universities, and it's a model which works both from the investor because they get an asset, and also have an operator long-term commitment from such universities. So I think this space is interesting, and I think likely to do much better. But we have to see maybe next 6-9 months time how things overall evolve on the residential front.
And how about retail? Just a quick one because I'll go on to the next question.
Yeah, I think retail comparatively to hospitality, I'll put both them in the same bucket. Will definitely recover. I think much faster. And obviously the issues on hygiene where people will travel back to mall is yet to be seen. But I think it will recover faster. See, also the point is India has very limited grade A malls, as we spoke about commercial. In each city, you have very handful of malls which are good ones, grade A. So ultimately, in India, retail malls are even entertainment destination. It's just not about shopping; it's about overall experience. So I think it will come back soon.
Sure. Okay. Now, from an occupier perspective, there's a question that how has the occupier markets impacted, especially on the new base build projects?
Sorry, I didn't get it, Megha.
How has the impact on new base build projects been from an occupier perspective?
So, like I said before, I think people will go slow on speculative buildings if we are looking into something like that because of the labor shortage, cash crunch, right? So they will be a little a step back on this at this point of a time, but they will be more forthcoming in currently doing any build to suit because you have a committed client and you get to go back and take that lease, go back and mortgage to the bank and take again a loan against that. So that becomes much faster from that perspective, right? So speculative will take a beat for some time, and but again, there will be some markets in the country which is a low vacancy market, and everyone understand that this industry come back very fast and the opportunities come back very fast. So there we still see some speculative construction will happen, but in the market where the supply is more, there are certain cities in India where supply is coming much higher than other part of this other part of the city. There we see a slowdown which will come down. That's it from a construction perspective.
Sure. Just to remind our audience, please write your questions on the box on the panel, and I will take them after we have closed the discussion, right? Don't forget to drop your questions. So another one very interesting, I think the big question is why here, that why people are not considering or investors are not considering residential assets, because individually everybody would want to buy a home, right? And at these times the sales should actually pick up. This sector is highly overlooked. What is your opinion and feedback about this?
So, Megha, if you see, residential has been under stress, and this has nothing to do with COVID. It's seeing a lot of
Correct.
stress for last, 18 to 24 months time, and this is pan India. See, the reality is the investors in real estate, which were mainly certain set of NBFCs and banks, who invested heavily for last 5 6 years, and maybe about 2 lakh crore they invested. Now those entire set of investors are out of the market. They are not investing. So wherever they've invested with large and small developers, they want to pull out capital. So the projects are stuck. It's halfway stuck. Some are late mile. They are stuck. So there is so much of negativity about people investing in real estate that whether I will get my delivery or not. I think this is the biggest question today, which you and I, as a retail customer, also will think before investing in. Everyone wants to buy in only with the with a very great corporate or tier one developer.
Yeah.
So all this, what might happen is we might see a lot of consolidation. We have been seeing this in last few years, but this might even accelerate to a great extent. And real estate, if you see, every 10 years, the top 5 developers in each city in residential change, and we can see most of the markets. So people who ruled in last 10 years may be different now, who will rule for next 10 years time. So we might see a lot of consolidation happening. One consolidation happens, the large set of developers or maybe corporate developers will acquire a lot of projects from the existing ones, which will, I think, create a lot of confidence, not only from the investors perspective, but also from the retail customers perspective. I think today
Correct.
what is challenging is the lack of confidence. It's not that people don't want to buy apartments, right? People, as a psychologian, we want to buy apartments. It's that you want that confidence that where I'm putting my money, whether I will get my apartment or not. Then obviously there are some financial consideration about home loan rate. I think this is fine. In fact, now with the government being proactive in reducing interest rates, we are below sub 7% home loan. So this is definitely very positive in a positive direction.
Yes, so I think just add to this answer also that there has been a demand supply mismatch in this segment for a long period of time. But I think it's high time that the corrections will seep in. They are in certain markets, and this is the right time. It's a long-term play for investors also, and it's here to stay. So definitely, it is something that investors and individuals should look out for. Now, one more question on the occupier side for Arpit. Do you see any change in occupier specs and requirements in selecting spaces? How important is design innovation in this market? And what are occupiers looking at?
So again, there will be a lot of innovations which will be coming in on this. And while we talk about the specs, which is the building specs, and the design, which is your interior, so there will be still a lot of innovations coming in. There's already a lot of debate which is coming in. So base building specs for a grade A asset, I don't think so it is going to change. Only thing is that most of the developers, what they are trying to do is that they are bringing an asset which is more sustainable, having at least an IGBC or USGBC gold or platinum rated, because that is where carbon rating is effective from an occupier perspective, and they make long-term commitment from a lease perspective. Now, from a design perspective, there will be innovation, and while last few years we were talking about open offices, before we were talking about the closed offices, right? Now, I think there will be a division in space which will come in. Because of the social distancing norm, there will be a lot of space which will be given from an employee perspective. The distance between one employee to another employee, now previously it was back to back and very close to each other. I think there was a lot of space which will be given. Collaboration spaces will still has to be on the highest side, because that is where all your employees come down in a short team break or a long team break, because that is where you would need it. I think it will go for a lot of innovation. While we speak about it, I hear from a lot of my friends who are from architects, there is already a lot of discussion which is happening on this.
And then technology will play an important role in the new office design.
Absolutely. Now,
right. So the core will be technology, and other aspects will be fitted.
It has to be. Technology cannot go away, whether it is a real estate or anything else. So technology artificial intelligence technology will take a forward seat going forward. Maybe now we were seeing while we were entering our offices, we were having a more biometric setup. maybe going forward, there will be more of eye scanners which we see in the market because there is no touch there, right? So there will be some innovations and something further which will has to come, which is a less touch and more onto technology which can evaluate everything.
Okay, and the next question I will actually club with my question also, which I wanted to ask. It talks about the recession in the US, and now the businesses are getting impacted. So how developers and builders helping corporates to tide over the recession? So I think this question means that are developers offering an incentive on one part. On the second part, I would like to ask that a lot of GICs are originating from the US and the UK. Now, since there's a slowdown, how does it look like? Are there is still demand from these countries for GICs? Arpit, you'd want to take that?
So there will be certainly a demand, and like I was sharing this before equally, that when these kind of an issue comes in, when there is a stress which comes in US market now, there is a stress which is coming in European market now. H1B visa, which was cancelled, means we will have more people. Our right talent will have to be here itself because the confidence level is coming down. Means we will have our talent back here, and with a talent back, there will be always a set of opportunities. Now, and equally when the US goes slow, business has to move on. They will go down to countries which is low cost centers and high talent, and India is always rated higher. Now, we will need to see when it comes to in India whether these things will go back only to the tier 1 cities, or they will go back and talk about tier 2 cities, because that was a noise which was there in 2008, 2009, and people are looking beyond tier 1 cities, and there were tier 2 cities which were identified. But later, people realized there was no talent there, and talent always wanted to back with tier 1 city because of social infrastructure, public infrastructure, and the job opportunities which they have it. So again, this is innovative times and challenging times. I think everything is open at this point of a time. Anything which is coming here, I think will be welcome.
And are developers helping the organizations to tide the crisis because the businesses from the US are slow?
They will have to be, because it needs to be hand in hand. If someone is saying that I will not be flexible, that cannot be era. This era is flexibility. Right? So maybe they will not be very vocal about it, but there are ways and means where they are going back and trying to help. If you the challenging time is that if I'm living in a micro market where the rental is 100, right, and I'm paying a renter in those micro market, which is a low vacancy micro market, and today my rental is around 40 rupees and 50 rupees. Now, if I'm looking at discount from a market rental, anyhow I'm 50% discounted, right? I'm looking about more discount further. I think that's not the right thing to talk about it. But in case if we go down to the market where we have invested recently, and we are equal to market or above the market, there we can go back and talk about opportunity. Developers are flexible. I have seen them showing flexibility. They cannot be vocal. That is for sure. They will not be vocal because it's only herd mentality sometimes which follows them. That is where the scare come in.
Correct.
They will support certainly in these times.
Yeah, we'll take one last question from an investor perspective. What are the immediate strategies that you would recommend for investors in the current market? Piyush, a quick one on this, and then we'll just wrap the discussion here because we're short on time. Sorry, go ahead.
Right. So I think the immediate ones, is credit, doing some high yielding debt in next 3, 6, 9, 12 months time, because this is an opportunity which may not remain for long. One. Number two, on the commercial side, specifically definitely on a forward purchase, I think there are a lot of owners who want equity tie-ups for very marquee locations. On the retail and hospitality side, this has been impacted the most, but which also gives a lot of good opportunity for at marquee locations, absolute grade A properties to be bought out, both on the hotel and the mall side.
Sure, great. I think we are short on time. We will get back to all the questions for individuals who have posted here, one-on-one through emails. Also, you feel free to get in touch with any of us here. Before we sign off, I would just like to summarize some points from our discussion as key takeaways. First thing, the office markets are solid. Yes, we expect a slowdown and delayed decision making, but the markets will rebound in 2021. Occupiers, some of them are adopting flex and core model, which means a combination of leasing spaces in traditional office space and also in co-working spaces. They're also following a hub and spoke strategy, which we talked about. On the investment side, yes, there is a decline in quantum of investments into India this year. However, there are bright opportunities in hospitality, retail, and residential asset classes. Office assets will obviously continue to be the favorite play for investors because of the steady income. On occupier side, again, there will be less of speculative, buildings coming up. Supply side will be slow, but yes, there's light at the end of tunnel. We should all stay positive. This is just a phenomena that we are sailing through, and 2021 will be a new bright year. With this, I'd like to thank you all again for joining. And we sign off from here. Have a good weekend. Stay safe.
Thank you.
Thank you.
Thank you.
Thanks.